So what's going to happen with variable rates? So a couple of just high level numbers. It's about it's about $30 for every $100,000 in mortgage. So if you have a $100,000 mortgage, you can expect your variable interest rate to drop by about $30. If it's with most of our big banks do it this way, where your payment doesn't change, the interest rate changes. So more of your payment will be going towards principal, about $15 for every $100,000. And if you have a handful of other lenders, which is an adjustable rate mortgage, your payment actually does go down by that $30 a month.
Fantastic for every $100,000 in mortgage. And I mean, that's going to be probably on average in the GTA for somewhere between $400,000 and $600,000 mortgages. I don't know, depending on where you are in the life cycle of your payments. But I think
if you have $1 million mortgage, that's $300 a month.
Yeah.
That's pretty significant.
That will offset the inflated cost of food. So that'll help make you feel like things are getting back to normal, which is fantastic, because we haven't experienced normal now in 4 years, 5 years. We are running up on too long since we've seen normal. But the big takeaway for me here is that this moves 5-year variable rate and a 5-year fixed rate. Almost now we're back on par. So we've had the last couple of years of fixed rates being lower than variable rates, which is the first time that we've seen that in, 50 years. My lifetime anyway. Variable rate has always been less than the fixed rate. But so if you have a good variable rate discount, like a prime -1, prime is now moved down to 5.45, making your effective 5-year rate 4.45, which is where the fixed rates are sitting. So that's great news, and I think there's more great news to come.
Yeah, I think this isn't the end of the rate cuts for sure. I think we've actually seen our fixed rates increase as well over the last week or so. Trump's threats on 25% tariffs have pushed our fixed rates up. Now, the bond yields, which the mortgage rates are based on, they've come back down a little bit, but our fixed rates haven't dropped. So I expect to see that our fixed rates actually will probably drop a little bit, not necessarily because of the Bank of Canada's rate, but because there's no more margin now for those fixed rates to come down a little bit. So I think it's still slightly a lower rate to begin with a fixed rate, but it's very, very close. And especially with the trajectory of where the variable rates are going, a lot of people will probably start considering variable rates a little bit more seriously now.
Well, once it comes in line with the fixed rate, then the qualifying rate and the stress test, then that's an even playing field. So that is like ultimately choice for the consumer. Because sometimes if you're at the peak of your affordability, you have to take whatever's the lower rate, even if if you don't particularly want a fixed rate, but you can get that little bit extra money to get you to your home purchase, then you might go with a fixed rate with a 30-year amortization, for example. But when they're in line, then that's ultimately more choice for the consumer, which puts us all in a better place.